Americans currently owe a staggering $1.6 trillion in auto loan debt. Disclaimer. This video provides objective educational analysis and does not constitute professional financial advice. A vehicle was once a powerful symbol of absolute freedom and the American dream. Today, it has transformed into a heavy financial anchor sinking the American middle class. Welcome to Inside Hay's Mind. Today we explore the psychology behind the auto loan bubble. The average monthly payment for a new car in America recently crossed $700. To understand this crisis, we must look at how dealerships manipulate human behavioral psychology. When you walk onto a car lot, salesmen rarely negotiate the total vehicle price. Instead, they strictly ask one dangerous question: what monthly payment fits your daily budget? This successfully taps into present bias, making you focus only on surviving 30 days. Dealerships actively use this psychological blind spot to sell much more expensive luxury vehicles. To make the math work, they simply stretch the loan term out to 84 months. 7 full years of payments make a $60,000 truck look completely affordable. Your brain gets the massive dopamine hit without feeling the immediate financial pain today. However, this timeline creates a severe mathematical disaster formerly known as negative equity. Unlike real estate properties, vehicles are rapidly depreciating assets losing value every single day. The precise moment you drive off the lot, the car loses 20% value. During the first few years of an 84-month loan, you mostly pay pure interest. The point set, your loan balance drops incredibly slowly, while the car's actual market value plummets instantly. This mathematical gap means you quickly owe banks far more than the vehicle is worth. Being underwater on a car loan traps you in a very fragile financial position. If your car is completely totaled in an accident, insurance only pays current market value. You could personally owe the bank thousands of dollars for a car that no longer exists. Dealerships sell gap insurance to cover this difference, adding even more to your total debt. The situation becomes exponentially worse when you decide you want to buy a newer vehicle. Americans generally keep their cars for only about 4 to 5 years on average. But your lawn was mathematically designed to last for a massive 7 full years. When you return to the dealership to trade in your current vehicle, the trap activates. The trade-in value of your car is significantly lower than your remaining bank loan balance. The dealer offers to roll that negative equity directly into your brand new car loan. This creates a catastrophic snowball effect that continuously destroys your long-term net worth completely. You are now paying interest on a completely new car, plus a car you no longer own. The new loan has an even higher monthly payment and another 84-month term. This cycle traps the middle class in a state of permanent, stressful consumer debt servitude. Financial institutions love this cycle because it guarantees decades of consistent, highly profitable interest payments. Over a lifetime, this constant car payment diverts hundreds of thousands away from your retirement. If that monthly payment were invested in index funds, the compounding interest would create massive wealth. Dealerships are not selling transportation. They are essentially selling complex financial debt products to consumers. To escape this bubble, you must drastically change your psychological approach to purchasing vehicles entirely. Rule number 1. Stop focusing on the monthly payment and focus purely on total cost. If you must finance a car, follow the strict mathematical 24-10 financial rule. Put at least 20% down to completely avoid immediate negative equity upon driving off. Keep the loan term to 4 years or less to drastically outpace the vehicle's depreciation. Ensure the total transportation cost is less than 10% of your gross monthly income. If you cannot meet these rules, the brutal mathematical truth is you cannot afford it. Do not let your ego or societal pressure force you into a devastating financial trap. Driving an older, paid-off reliable car is a strong sign of true financial intelligence. It proves you value long-term wealthy freedom over short-term depreciating metal and plastic. We must normalize holding onto our vehicles for a decade to rebuild middle-class wealth. Master your psychology, completely reject the monthly payment illusion, and reclaim your ultimate financial power. The dealership system is not your friend, it is a highly optimized profit-generating machine. Educate yourself before signing any contract that legally binds you for the next 7 years. Thank you for watching Inside Hay's Mind. We hope this objective data protects your wallet. If you found value in breaking down this trap, please smash the like button now. Again, share this video with a friend who is currently thinking about financing a brand new car. Ensure you subscribe and turn on notifications so you never miss our next financial deep dive. Remember, true wealth is what you secretly save and invest, not what you visibly drive. Escape the consumer matrix. Stop feeding the banks and start aggressively feeding your own future. The $1.6 trillion auto debt bubble will inevitably burst at some point. Make sure you are safely standing on solid financial ground when that storm finally hits. In our next video, we will expose the hidden psychological traps of student loan forgiveness programs. You definitely do not want to miss that critical analysis of the American education system. Until then, keep questioning the financial norms that society aggressively tries to push onto you. Take a deep breath, review your monthly expenses tonight, and find areas to aggressively cut. Redirect those wasted dollars toward assets that actually build your future generational family wealth securely. A paid-off car is the ultimate status symbol of someone who cannot be psychologically manipulated. By rejecting the 84-month LAN, you are silently rebelling against the debt system entirely. This rebellion is how the middle class finally breaks the chains of continuous paycheck dependency. Never let the shiny paint of a depreciating liability blind you from mathematical financial truth. Stay incredibly sharp, intensely focused, and always objectively analyze the numbers before signing anything binding. You have the power to completely change your family's economic trajectory starting right here today. It simply requires discipline, patience, and the ability to delay your primitive dopamine gratification system. Let the math guide your logic, not the intoxicating smell of a brand new car interior. This is Inside Hayes Mind, signing off. We will logically dissect the next bubble soon. Stay wealthy, stay independent, and we will see you safely in the next full episode.